Hello everyone and welcome to Moementum channel. My name is Mo, and in this video we have a lot of topics to go through. First and foremost, I want to share with you the concept of self-made dividends. A simple concept as a whole, but one that I came across and got to know a little bit more about through one of the financial planners here in Canada, Ed Rempel. I've definitely noticed that he's tried to popularize this concept, the way that he coins it, and how he's tried to talk about it as one of the best ways for many investors who are thinking about planning for their retirement years to take advantage of that. So I'll share some gist of what it is all about and what are some of my reflections on it and whether I think that's something that is applicable to me and potentially to other investors out there. If you haven't checked out Blossom app, and if you are an investor here in Canada, you definitely want to do so. It's a wonderful community of over 60,000 Canadian investors, including beginner investors as well as those who are very experienced, all coming together, sharing their expertise, experiences, lessons learned, failures, mistakes, successes, and through that communication and interactions, learning from one another. There's also a ton of amazing content, educational ones that you can access for free. On top of that, by joining Blossom, you'll be able to share as well as follow along other investors' trades as they happen to a different brokerage account. They are going to be posted in Blossom app. So it's pretty neat. You want to definitely check it out if you haven't done that so already. The download link is provided in the description of the video. All right, first things first, I want to show you how easy it is to set up a recurring buy for your Wealthsimple account if that's something that you desire to do. In this case, I first went into the holdings that I have, or you can just simply look up the stock or ETF that you intend to add to your portfolio. For us, I've already set up something for XEQT, but I'm going to show you from scratch. So I click into XEQT, which is the largest holding for our portfolio. If I click on buy, it gives me a few options, decides which account is it that I intend to buy things from. So let's say I want to do it through my non-registered account, even though it currently doesn't have any funds in it, but I can always set up a reoccurring buy. From the drop down, I am going to select the option of recurring buy, which is essentially gives you the choice to decide how much money you want to invest into this fund. So let's say for us, we are going to set up a $50, and we can even decide what's the starting date, what is also the frequency. Do you want to do it on a daily, weekly, bi-weekly, or monthly? Say we want to do it on a daily basis. Of course, this only happens on the days that market is open. And if you continue to the next page, pretty much is as simple as that. All you need to do is just connect your bank account. Which bank account do you want these funds to come out of? Once you go from there, it's pretty much set up and it's on autopilot every day. In this case, if it was a daily withdrawal or recurring buy, the funds will come out of your portfolio and you'll be able to actually see automatically the amount bought for your portfolio from there. As an example, if you look at my recent activities on my Wealthsimple account, you do see how I had recently updated my daily buy to $200. So for instance, on last trading day of November 10th, for the total amount, a total of 7 shares plus fractional shares of 0.599 was bought at the trading price at that time. Typically these are bought and I'm based in Edmonton. These are fulfilled at 1:02 p.m. On the market day in Mountain Standard Time. I believe it's closer to 3 p.m. Eastern Time. We want to move on to the topic of self-made dividends, and that's the topic that I indicated. I got to learn more about it from some of the recent blog posts, videos, and also a podcast that I was listening to from Ed Rempel. He goes through them in depth. I definitely will include the link to these articles so you can check it out. It has the link to the video as well, and other things. But what is self-made dividends in a nutshell? What it essentially is a simple concept that allows you as an investor to really not rely on the ordinary dividend. Instead, as you invest in the stock market as a whole and not really just solely focusing on dividend paying companies or stocks or ETFs, when you need the money, and that's a big kind of differentiation, you only withdraw funds when you need it, when you need the cash flow. So say right now you're still young, you're investing towards financial freedom, you're investing towards financial independence. You don't really need the dividend income from an ordinary perspective. Like if you get the dividend income, I would imagine for most of us, you're just going to reinvest the money. But the challenge with that is that in many cases, those dividend income, in fact, in all cases, they are subject to taxes. So you're going to be taxed on it. Depending on the tax bracket you're in, you're going to be subject to that taxation. Whereas If you really don't need the dividend income, and that's definitely applicable to me because I'm pretty much reinvesting the entire dividend income that I'm receiving, it might be wiser to just try as much as possible to avoid dividend income per se, because instead you can take advantage of these concept of self-made dividends, which means as your funds grow over time, let's say when you get to that retirement age, in order for you to create that passive income for you, you can just sell a portion of your funds, take advantage of that at that time, and create a cash flow. And how it works, let's take a look at it with one example here. So say, imagine you have a portfolio in your retirement that now is amassed to a total of $1 million. Depending on what is that safe withdrawal rate that you want to go for. So let's say 4%, just to keep things simple, but you can obviously play with this number, whatever number that you're comfortable with, you can play with it. So $40,000 is the 44% of the $1 million that you can withdraw. Imagine at the beginning of the year, you want to withdraw 4% or $41,000 from your portfolio. Now, that's the income, that the amount, the cash flow that you will have that you can utilize to sustain your expenses throughout the year. In this case, just to go through a more concrete example, we had assumed that in your portfolio of $1 million, you had only invested $500,000, and the rest of it was actually through the growth of your portfolio over the past, let's say 10, 20, or 30 years, it got to that level. So if that was the case, if you sold $40,000 of your investments to withdraw that amount, because you had your portfolio had doubled in value, only about $20,000 of it was actually your gain. The rest of $20,000 would have been your initial investment, assuming that we said that in this case you had a 100% growth in your portfolio value. Now, because out of that $40,000 cash flow that you had, $20,000 of it was only capital gain. With capital gain taxes, the way that they are taxed in Canada, only 50% of capital gains are taxable, subject to tax. Hence, only $10,000 of it is a taxable gain, subject to, again, your taxation brackets and all of that. What it tells us is that unlike an ordinary dividend, whereby if you, let's say you were paid $40,000 in dividend, and all of which was subject to tax, here only $10,000 in our example would be a taxable capital gain. And Ed Rempel has multiple posts as well in his blog. There is another blog post that I would link it in the description of the video. He talks about how the lowest tax type for investment income is in fact the deferred capital gain, which is the case here as we talked about. He also points out some other consideration here further down in the article, that how self-made dividends are better than ordinary dividends. You decide the amount of dividend you receive, because you can decide how much you want to sell out of your portfolio to generate that cash flow. You can also start, stop, and change the dividend at any time you want. You have full control over it. You're not forced to pay taxes on dividends when you don't need the cash. Say right now, you don't need the dividend income because you're reinvesting it. Why then choose, if you had a choice, why would you actually go for dividend income, ordinary dividend income, as opposed to just waiting, only withdrawing it when you need it at retirement? So it might be to your advantage to kind of defer it as much as possible, let the full amount grow without you having to pay taxes on it at this point when you don't need it. You can invest properly based on risk return. You can avoid buying expensive investments to get a higher dividend. This goes based on the concept that some folks are trying to chase dividend, which is not advisable whatsoever. But in order for them to do that, they're only focusing on also a limited number of sectors or companies which have high dividend yields, really lowering their diversification and potentially overexposing themselves to certain financial sectors. There's a lot to cover, including some charts and some tax rates that he's gone through. I'm not going to go through them in depth. For me, given that my wife and I are at least, I would say, 10 or so years away from our potential retirement age of early retirement, it is probably wise for us, as I reflect on it, to try to minimize as much as possible the dividend income we get. Because what we are doing with it, we are not actually using that dividend income as a passive income to do anything with it. We are just reinvesting it. So why would we really aspire to get dividend income? The more I think about it, it does make sense absolutely for us to try to minimize it. Now, there are some limitations to it for us. If you've been following our journey, you know that I'm mainly investing in index fund at this point. And we started this approach, more consistent approach, about several months ago, I would say from the beginning of the year. So it's not been that long that we're pursuing this passive index investing approach. But in doing so, there are some limitations that, this index consists of so many different companies. So for example, XEQT has over 9,000 companies globally, which is fantastic from a global diversification perspective, but we don't have any control of how much dividend we are getting from it, because so many companies out there actually these days do pay dividend. But what I'm happy with it is that at least it has a fairly lower dividend yield. Like I think hovering around 2%. It's not like a massive 3, 4, or even 5 or 6% dividend yield. It's kind of something that's outside of our control. You have to accept the fact that it does pay some dividend. We do have some other index funds in our portfolio, like VTI, that I believe has slightly lower dividend yield. But all in all, that's the approach that we are taking. We are reinvesting all the dividend income that we receive. I think the concept of self-made dividends does make sense to me, and I can relate to it, why it would make sense. I would imagine when we get to that retirement age, at that point, we can decide what is our safe withdrawal rate. Is it 3.5%, 4%, 3%, whatever that number is, that allows us to generate enough cash flow, but also sustain our retirement years meaningfully. And there was some question in the past, somebody was asking, hey, can you also elaborate how does this safe withdrawal rate work in conjunction with the inflation rate? Most of the research that I've read and heard about is that they do take into account the inflation rate. I mean, last year, we were like a very exceptional year. The inflation rate was so high, but typically the way that it works, it accounts for inflation. So for example, let's say you start your retirement years, fast forward, today is my first year of retirement. I'm gonna, as an example, withdraw 4% of my portfolio size. So let's say if I had a portfolio of $1 million, I withdraw 4% of it. Next year, at the beginning of the year, I'm gonna withdraw 4% of whatever that value of that portfolio at that time is at the end of December of this year. And plus, I would incorporate whatever the inflation rate is. So let's say in 2023, we're end of 2023, for next year, I'm gonna withdraw another 4%. If the inflation rate this year was, say, 3%, I would withdraw 40% plus 3% inflation rate multiplied by that total amount that I'm withdrawing. So 3% of that $40,000 equates to around $1,200. So for the second year, I would withdraw $40,000 plus the $1,200 extra to kind of account for the inflation that we've had over the past year, because I need to gradually increase my withdrawals to account for and kind of keep up with the inflation. Otherwise, if I just always go 4%, 4%, 4%, it may not really account for that. So that's a wiggle room that I have. I can account for that easily. You're, of course, going to have to monitor your accounts and see how your portfolio size is growing over time. Because if you're seeing you're depleting your portfolio too fast, then maybe the number that you had in terms of withdrawal rate might not be as sustainable. So you have to adjust it accordingly. It also depends on what is your total expenses, what is the size of your portfolio, and what are some of those discretionary expenses that you have during your retirement that maybe you can let go of, at least temporarily, until your portfolio kind of rebuilds itself, so you're not depleting your portfolio quite too soon before you kind of age enough. As you know, these days, the average age for folks that they can kind of live is quite long. So you have to make sure you have sufficient income to be sustainable for you, and you're not running out of money. Now, I know there are a lot of fans of dividend income on Blossom, as well as among Canadian investors, and many folks that, even some of my friends that I've been following their journey, that they've actually basing their entire retirement on dividend income. So don't get me wrong, I'm not an anti-dividend person, and what I'm sharing here is purely some of my kind of reflections on the concept of self-made dividends. I'm not discounting the fact that dividends can play an important part, and in fact, many retirement plans can be built around it. To each their own, and I respect that, I value that, and of course I wish everybody the best of luck in their approach to financial independence, financial freedom, retirement planning, and all of that. Lastly, before I wrap up, I just want to quickly show you the portfolio, where things are at. I talked about the overall portfolio size. You see the three holdings that we have: VTI, XEQT, and VT. XEQT is our largest holding, currently down by 1%. XEQT accounts for almost 92% of our holdings. VTI, which is in USD, we hold it in my personal RSP account. It's currently showing to be up by 3.1%, and VT, I also hold it in my personal RSP account. It's currently down by about 1.4%. You do see here how much is the entire amount invested, how many shares in total we have, market value, what's the expected annual dividend income, as well as the expected annual dividend income for our entire portfolio, and what is our breakdown of investments between different types of account, non-registered, tax-free savings account, and RSP account. Thank you so much, everyone, for watching this video until the end. I know this video was a little bit long, so I appreciate your patience. I will definitely add a little bit of that, breakdown of chapters of the video, so you can easily jump to the topic that you're interested in. If you'd like me to cover any other topics for future videos, do let me know. I'll be happy to cover that in subsequent videos. Thank you so much, and I hope to see you all next time.